Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Xinte Energy Co. Limited annual report. Xinte Energy Co. Limited is a Chinese energy company that offers a diverse range of businesses and services. At its core, the company specializes in the research and development, production, and sale of polysilicon, a key material used in the manufacture of solar panels. In addition to polysilicon, Xinte Energy also engages in the construction and operation of wind power and photovoltaic (PV) power plants. This includes developing, constructing, and operating these facilities to generate electricity from renewable sources. The company's product portfolio extends beyond energy generation, with a range of electrical equipment and materials being developed and sold. These include aerated blocks, zirconium-based new materials, inverters, flexible direct current transmission converter valves, and static VAR generators. Furthermore, Xinte Energy offers various services to support its business operations. These include logistics and electric power design services, as well as inspection and testing services. The company's expertise in these areas enables it to provide a comprehensive range of solutions for its customers. Overall, Xinte Energy Co. Limited is a multifaceted energy company that operates across multiple segments, including polysilicon production, wind and PV power plant development, electrical equipment manufacturing, and service provision. Xinte Energy Co. Limited market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Xinte Energy Co. Limited holds a significant advantage in their industry. Xinte Energy Co. Limited trades at a lower price-to-book ratio of 0.21 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 57% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. Revenue growth is primarily driven by the operation of wind power plants, which generated an additional $9.99 billion in 2025. The wind power and PV segment also experienced significant growth, increasing its revenue by 21.4% due to higher operating revenue. Optimized electricity prices through cross-provincial green power trading, increased on-grid electricity from self-operated power stations, and completed construction projects contributed to this growth. Furthermore, the company's focus on enhancing quality while reducing consumption, decreasing costs while increasing efficiency, project development, cost reduction, and efficiency enhancement also led to revenue growth. The increasing proportion of high-value-added products, reducing production costs, achieving efficiency gains, key technologies and process breakthroughs, energy services, and key equipment manufacturing were other drivers of revenue growth. On the other hand, revenue decline was primarily driven by a significant decrease in sales of materials, byproducts, and other miscellaneous services. Overseas revenue decreased by 35.5%, while domestic revenue in the PRC declined by 35.3%. The main business's revenue also decreased by 27% due to various factors such as year-on-year increase in newly installed power generation capacity and market price of polysilicon products. The polysilicon segment experienced a significant decline in sales volume, with a decrease of 62.26%. This was accompanied by a drop in sales revenue, which further contributed to the overall revenue decline. Net income experienced a significant increase of approximately 15% compared to the previous year's corresponding period. This growth can be attributed to optimized electricity prices and enhanced power trading capabilities. As a result, the company's financial performance improved. Profit margins also underwent a notable change. Initially, they improved due to various factors such as reduced material costs, increased operational efficiency, and enhanced equipment performance. However, this trend was short-lived as profit margins were later compressed due to increased competition in the PV industry. Despite this setback, the gross profit margin still managed to increase by 2.9 percentage points to 9.32%. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. According to the provided information, the company experienced a substantial net cash outflow from operating activities, amounting to $115.73 million in the year ended 31 December 2025. This negative operating cash flow is a major concern for any business, as it can lead to liquidity problems and hinder future growth. The company's debt level has undergone significant changes over the past year. While total debt has increased by $1.8 billion, notes payable have decreased by $3.7 billion. Long-term borrowings have seen a modest increase of 6.8%, while short-term borrowings have risen by $521 million. In terms of interest expenses, there is a notable decrease from $711.2 million in 2024 to $669.3 million in 2025. However, financial expenses have increased slightly from $601.6 million to $612.4 million over the same period. These changes suggest that while the company's debt level has grown, its interest expenses have actually decreased, indicating a potential shift towards more favorable borrowing terms or reduced interest rates. The performance of various segments and regions in the industry has been mixed. On a positive note, the polysilicon segment has shown strong performance, as indicated on pages 13 and 14. The electrical equipment segment also performed well initially, but its performance declined later on page 14. Additionally, the operation of wind power and PV power plants was successful, with a notable increase in wind power capacity in China by 50.4% year-on-year. However, some segments have underperformed. The construction of wind power and PV power plants has been a challenge, as mentioned on page 14. Furthermore, the electrical equipment segment's performance declined later on page 14. Intersegment elimination, impairment loss of credit, and impairment loss of assets also experienced difficulties, as highlighted on pages 13. Certain segments have unclear performance indicators. The sales of materials, byproducts, and other miscellaneous services do not provide a clear picture of their performance, as stated on page 12. Similarly, the construction and operation of wind power and PV power plants have ambiguous results, noted on page 12. Management's vision for the company's future is centered around several key strategies. Firstly, they are placing a strong emphasis on wind power and PV operations, recognizing their importance to the company's overall success. This focus will be complemented by a shift in approach from scale expansion to high-value development, allowing the company to transition into more lucrative markets. In addition to these operational changes, management is committed to developing renewable energy sources and promoting internationalization of green certificate applications. They are optimistic about the prospects for growth, driven by increasing demand for renewable energy and expanding installed capacity. To achieve this growth, the company will focus on building core competitiveness through strategic development, organizational reforms, and talent optimization. Furthermore, management recognizes the importance of prioritizing cash flow security, ensuring that the company is resilient against risks and maintains production and operations stability. By implementing these strategies, the company aims to establish a strong foundation for future success and capitalize on emerging opportunities in the renewable energy sector. The company's financial records indicate a payment of dividends. This is further supported by the decline in dividends receivable on page 2, which shows a decrease from 2024 to 2025. The reduction suggests that the company has fulfilled its obligation to pay out dividends to its shareholders during this period. Concerns about inventory buildup and supply chain disruption are growing due to several indicators. One key metric is the decline in inventory turnover rate, which has decreased significantly from 4.74 to 2.77. This suggests that companies are holding onto their inventory for longer periods, potentially leading to increased costs and reduced efficiency. Another concern is the increase in inventory turnover days, which have risen from 76.01 to 129.8. This indicates a slower pace of inventory movement, further exacerbating the issue of inventory buildup. Additionally, high social inventory levels are also a cause for alarm, as they can lead to supply chain disruptions and decreased customer satisfaction. These indicators collectively point to a potential crisis in inventory management and supply chain efficiency. If left unchecked, these issues could have far-reaching consequences for businesses and the economy at large. That concludes the financial summary for Xinte Energy Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.